you guys saw the recording. Just a brief overview of what happened. Oh, by the way, I updated my art studio, so it looks nice. There's something really cool that you can do. It's this. Okay, so we saw that in general, if we have two non-stationary time series, x and y, and these become stationary when differenced, so initially the series are I1, integrated order 1 series, they are basically like a random walk, right? And an example is a random walk. However, if we have a linear combination of these two series, and of these x and y, and this combination turns stationary, so I0, we say they are co-integrated. Some examples we're talking about in real world data is income and consumption. Income rises, consumption rises. Income falls, consumption falls. The story of a book with its movie adaptation. So if you read a book and somebody adapts it to a movie, then there might be small differences, but you have a good idea of what's going to happen, right? The number of patients that enter or leave a hospital. So if we have 20 people that leave a hospital, it means that 20 beds are opened up, which means that more people can come in. So why do we care in finance? Suppose that we have X and Y stocks, and we said that, for example, X is Coca-Cola and Y is Pepsi, and we know that they are co-integrated in a relationship such as X minus 2Y is equal to Z being an stationary I0 series, probably zero mean. By following the relationship, then Coca-Cola is usually priced twice as high as Pepsi. Now imagine that Coca-Cola is priced more than twice than Pepsi. How do we expect Coca-Cola to move, or how do we expect Pepsi to move? So the trading strategy would be if our long-run co-integrating relationship, so our long-run equilibrium, so x minus 2y, is greater than a certain number, and that certain number is greater than some number, we sell Coca-Cola and buy Pepsi. Why? Because we want to reduce that formula, right? And since Coca-Cola is X, we diminish X in order to reduce our co-integrated relationship. Likewise, if it's the other way around, we do the contrary. So, for example, with numbers, if Coca-Cola right now is priced in at 35, Pepsi is priced in at 15, our formula gives us 5 when it should give us 0. Okay, so either Coca-Cola should go to 30, or Pepsi should go to 17.5, or something in between. We talked about the Engel and Granger test. So the Engel and Granger test allows us to know the relationship of these two variables, these two time series. First of all, we need to know if x and y are actually I1. Then we estimate the co-integrated relationship, what we just talked about, by using a simple OLS. Then we check that the co-integrated residuals are stationary by using a unit root test. This procedure, and we're going to apply it, is also called the co-integrated augmented Fourier procedure. Okay. We talked a little bit about co-integrating. Let me here. The next delta. We talked a little bit about error correction models. So in general, we have that we can represent our x and y. We have that we can represent our x and y because they are co-integrated, we can represent them as one, an ARMA or an ARNIMA or just a simple AR in this case, for the variable with the external information that the other variable is adding to it. However, something more useful to us is the Granger representation. So we can Granger represent it as the deviation of the long run mean, the long run equilibrium, I mean, for the variable. So remember, we said that the relationship in between these two variables is the long run co-integrating relationship. And we have two very important coefficients in this kind of representation. One, which is called the optimal hedge ratio, and we're going to talk a little bit more about this later. And then the alpha. The alpha is two things. The alpha is one, the direction of the disequilibrium, and then it's the speed in which the series will correct itself from the disequilibrium. And we talked about Keynes, and we talked about how the market is always in disequilibrium, and the disequilibrium is the most important part, etc. Okay, so in summary, cointegration is an equilibrium relationship between time series that aren't individually in equilibrium because individually they are I1. It is useful to us because it allows us to incorporate both short-term dynamics, so deviations from the equilibrium like the Granger represent, and long-run expectations or corrections to a long-run equilibrium. And we saw some examples with different unit root tests. We talked about how the augmented Dickey-Fuller is the better of them all. However, these two also can help you confirm your ideas. We did a little bit of an example with numbers, and that's where we left off. We were just after this talking about how this applies to the world of equity. We're talking about Pepsi and Coca-Cola. We're talking about McDonald's and Burger King. We're talking about different kind of OTC commodities. But let's go for this class. We also tested how a bad combination doesn't actually co-integrate with the series. So if you want to see how this ended up being, let me run everything. It's easier. So the good combination looked like this. However, the bad combination didn't look stationary at all. Okay. That's where we left off last class. Okay. By the way, there's one mic open. I don't know who is it. But I'm going to mute you. Sorry. There you go. Okay. So where we left off was we were going to talk about doing a procedure with this co-integrated augmented Dickey-Fuller procedure. So our main motivation to do this procedure is actually finding this beta. Okay, this beta is very important because it's what allows us to know what is the ratio that we are going to use in our per trading strategy. Okay, so it is usually hard to find it. However, if we go both directions and we follow this procedure, which is relatively simple, we can take a sample of historical data in between both of the stocks or of the assets and then do a simple linear regression from them to find one, the beta, which is the optimal hedge ratio, and the alpha, which will give us information of the direction and the speed of the correction. Okay. So first of all, let's see how we can do this kind of procedure. Let me go back to the code way of seeing things. There we go. So, simulating integrated augmented computer. Qué día. So let's make up some data, okay? Remember, if you set a seed, then your results will be reproducible. Let's just use the same simulation. And let's go for, again, the same PQ. We have some simulated data that if you look at it, we have looked at it before. If you look at it, it does look like stocks that are in a very correction market, for example. So it works. They come from a white noise and these two coefficients. And now, remember, the procedure told us to make a linear regression between them. So the combination that we're going to do, as and I think it was Omar that asked yesterday, how do we find this A and B that we put in by hand? So these 2 and -1. So this is how we find it. We do a linear combination, a linear regression in between both of them. So let's do a linear regression in between x and y. So how do you see the summary of, how do you interpret the summary of a regression? You should actually be very comfortable with this because it looks like every single other linear regression result of any program. This is your coefficient. In this case, this is your what, guys? What does this number mean in the terms that we were looking at before? Okay, I'll make it easy for you. This one is our beta. Okay. And this should be our alpha from the regression that we were looking at before. The long run equilibrium that we were looking at before. Which means that y, yeah, y is twice as dependent than x. And why does it make sense? It kind of makes sense because we make q double the value of p, right? Yeah, exactly. The relationship of, on both variables. So now that we look at it, we need to run an ADF test on the residuals. Series ADF test combination residuals. Only do one lag. Okay, so our p-value is really, really small. And we checked what this meant last class, right? So because our Dickey-Fuller test statistic is very, very low, and also our p-value is really, really low, now we can reject the null, and we can say that there is no presence of a unit root. So we have a stationary series. Okay. And what does that mean? So if we have stationary residuals, it means that our cointegrated relationship is actually a cointegrated pair. So it will work. Okay. Now, this is not surprising. We actually simulated the data, so it should have given us this result, right? So now that we have a relationship, in this case, minus 0.06 of alpha and around 0.5 of beta, let's test it on actual data. Okay. Now, a really good example to do this, actual data, is on companies that list more than one class of share in the market. But something better might be, yeah, let's do it with ETFs. Okay. I don't know if you guys heard about QuantMod. QuantMod allows us to get financial data really easy. Okay. I'm gonna take the Australian iShares ETF. Let's get symbols. UA. Let's just pick a specific period. Let's say from 2006. But just so we don't get a commodity crisis. Two, 2012. 429. I need to do auto sign. Yeah. And also, I'm going to take the EWC, which is the iShares Canada. Now, who can tell me why these two countries, these two stock markets, should be related in a way? Anyone else? Australia. It's Australia and Canada. Nobody knows? Nobody works in investments? Okay, Australia and Canada are both markets that are very related to no, Alvaro. Alvaro?
Yeah, they are countries that are high correlated with the commodities, like
Exactly.
um, with the, for example, Canada is with oil and Australia is with gold and oils also.
Very good. Thank you very much, Alvaro. So they are countries that are very related to commodities. Usually, for example, The most used index options are one, the S&P 500, because it's very liquid and it actually lets you grab the general macro stock market. And two is Australia. And a lot of people wonder why somebody in their options portfolio has puts from Australia. And it's because you're actually not hedging against the Australian market. You're hedging against the commodities. Very good. So, um, so we need to get these two guys, and we actually when we download from QuantMod, we get this XTS. Smiley face. We get this XTS. This XTS is an extendable time series, which is a time series type of object. However, the part that we want is actually this column that's adjusted. It's not adjusted. Oh, it's not showing all of them. But EWA over here, the open of the day, the high, the close, the low. So you can build up your candles chart, volume traded that day, and we have adjusted. Why do we care about adjusted? Because companies and ETFs and other funds can also do dividends, can do splits, can do any type of movement. And thus they alter the nominal price, and the adjusted does a backward adjusting in order to get clean data. So for example, Apple did a split recently. I think it was 4 for 1. So their price cut in. So we need to get this adjusted column. ED for QuantMod gets us the adjusted column. So look at EWA and EWC. We only have 2 columns now. Okay. Now let's look at our data. It's always important to look at. Come on.
Excuse Gonzalo, what do you do with by adding the AD double parentheses
Just
thing?
grabbing the adjusted prices. So
Okay.
by using that symbols, we get the open, close, high, low, and the volume. We only want the adjusted prices.
Okay. Thank you.
No problem. Now let me quickly test on class. Right now it's an extensible time series. Yay. We don't get the dates by doing that. We just thought, I think the XTS pretty way of plotting, yes. So this is the Australian market, and this is the Canadian market. They look kind of similar, right? Why? Because they have some very similar drivers, and like we talked, these drivers are the commodities. Okay. So now let's see how they look if we plot them side by side. So if we, for example, do a data frame, and we get EWA, which is EWA adjusted, we get EWC, which is EWC adjusted. We plot it. just each price against each other. So X is EWA, I is EWC. So G on point. Minimal. They really go along each other. If you want, you can put a simple linear regression over here. You can smooth. And if we do LM, you get a really close relationship between both of them. Okay? So that is what we're going to do. We're going to check if these two assets have a co-integrated relationship and thus form a long-run equilibrium and can be used in a trading strategy. Let's do one combination. So just the same thing that we did with our simulated data, EWA, just set EWC. And also, we're going to check it the other way around. Why do we do the other way around? Because sometimes the residuals might behave differently when you change the dependent variable. For example, combination 1, equals plot these time. Let's just use ggplot. Data frame. Say yes. Also, let's E on through length. Residuals. First of all, let's see how this looks. ggplot. What kind of data is this? So residuals.
Disculpa, ¿qué significa ese punto?
Oh, sure. So by using the point, we saw this in the workshop, while using the pipe operator, it means that we are replacing in this formula the in this function actually the content that's behind the pipe. So we're using it's as if we were writing data frame residuals combination residuals ID 1 through length of combination residuals. Okay. Core data. There you go. Of fairness. There we go. Yep. Resume ID. Yep. That works. So let's do ggplot. Online. Set x. X is ID. And Y is res. Nine. minimal. But I don't usually use minimal, but I don't want to load my themes package. Okay, so these are our residuals. What can you say about our residuals? What do we need our residuals to be, for example? Okay, we did this with the simulated data, right? They're mean-centered, okay. What else? What do we need our residuals to look like? They turn into a white noise. So we need our residuals to be stationary. Okay, that is very important every single time that you're doing a regression. Okay, because if our residuals are not stationary, they probably have some kind of relationship, or we are omitting a variable in our equation, or they have a relationship with one of our dependent variables, in this case the other time series. Okay, if we look at the combination two residuals, both of them kind of look stationary, right? Now let's look at our combinations. Combination 1 and combination 2. So combination 1 tells us that we have an alpha of minus 1.3426 and a beta of 0.6956. Combination 2, and remember, it's both are the same assets, however reversed. Combination 2 is an alpha of 3.461 and a beta of 132.4. Now, the issue here is our coefficients are not the same. If this was a perfect example, our coefficients should be around the same value. Okay, so we need to use the augmented Dickey-Fuller statistic to determine one is actually the optimal hedge ratio. Okay, so let's do first combination 1. So in combination 1, and I think I haven't. So in combination 1, it's as a dependent variable Canada, and it's trying to explain Australia. Combination 1, the residuals 1, and it's a p-value of 0.027. Test it for the combination 2. It's really close, but it's a p-value of 0.028. Now, both of them are small p-values, so for both of them, we reject the null and find that we do not have a unit root. However, the ADF test for, was it the second one? No, the first one. So by using Canada as an independent variable is smaller. Okay, so we would choose this combination for our trading strategy. Okay, and what is the trading strategy? How do you build it upon it? Combination 1, let's look at it again. Summary of combination 1. you have an alpha of minus 1.34, and you have a beta of 0.69. Means that if you go back to the example that we were looking at with Coca-Cola and Pepsi, your equation is Australia is equals to what, guys? Nothing? Okay. Looks like you guys haven't got it yet. Not quite, but that's the general idea. Okay, so our let's put it into an equation. If we WA, so Australia, is equals to, where is it? Minus one. By the way, you can do this thing in R, where you put R and combination one. This is combination one, right? Yeah. So combination one functions one. Then we expand upon this, and we get coefficients 2, PwC. And hopefully when we render this, it works. But what Omar said is right? You can model Australia with this equation using Canada. And it works the other way around, right? So you can set up a trading strategy in which, when the optimal hedge ratio, which is 0.69, doesn't really apply, then you can, if Canada is, no, if Australia, let's put it more simple, since we have written it that way. If the price of Australia is higher than what we can model with this, then we need to short Australia and buy Canada. If Australia is lower than this long run equilibrium, then we need to buy Australia and short Canada. In which ratio do we do it? We do it in the optimal hedge ratio. So if you had a portfolio for just these two stocks, then your portfolio would be 69%. So your position on Australia should be 1/69 your position in Canada. Now let's see if this renders. Oh, it does. Awesome. Combination 1. Yeah, the one with the lower p-value. That's right. Okay, we've done it with ETFs. Let's, for example, do... We've done it with ETFs. Now, we can do it again for stocks. We can do it again for something else. I'm going to try... I think I have a data set over here for jet fuel. Hold on. Why not? There we go. It's this one, yes. Let me quickly download this. Tutorial 4, jet fuel hedging. Okay. Great. Okay. So read dot, in this case, I think this is a Sue. Hedging for separator. Separator should be a comma. Connection. Oh, okay. Let me try to do this. It's just importing the data, right, guys? Let me open it up some other way. Let me look at it. Hold on. It's a comma. Yeah, it should be a comma separated file. Okay. Cannot open connection. Oh, okay. Yeah, I see the issue. Working directory. Remember, guys, when you're using directions in R, you have to use the other slash. There we go. Awesome. So we have our jet fuel data. Look at header. Have jet fuel and heating oil. So it's not so if one of you works in the market, then you know that it's not easy to actually trade this kind of commodities, right? Because, for example, airlines are the natural buyers of jet fuel, okay? And the price of jet fuel can be really, really volatile. So most airlines actually hedge their prices for jet fuel. However, in the market, you don't have any kind of forward or any kind of swap for liquid jet fuel. So what can you use? You can use, for example, heating oil. Heating oil you can find OTC instruments for. Okay, so in a good department for the financials in an airline company should actually use a co-integrated relationship to find an optimal hedge ratio for jet fuel. Okay, good. OTC hedge. Now, since we clearly don't have an I, since we clearly have an I1 in our in our data because they are prices, right? We can use the differences of them in order to actually do our formulas. So let's do our combination. Okay, so simple combination. Let's do a linear relationship in between the changes in jet fuel. How can we explain the changes in jet fuel? Just change this because it doesn't only include the jet fuel, it includes the heating oil. We're hedging it against. Okay, so we've done this what 4 times already. So one of you tell me what this means. Any takers? Oh, I'm sorry, hold on. I'm going to do this like this. Why did I do that? Because I want to set the intercept to 0. Because remember, right now I'm not estimating the long run relationship. What I'm looking at is if we can get by one coefficient the relationship in between the changes of both of them. So what did I miss? No what? What does that 0.89 mean? Kind of, yes, but in not in statistics, in for our purposes. So imagine if the 0.89 would have been 1. What does that mean? If the 0.89 would have been 1, then we would have had a perfect cross hedge, because it means that we can perfectly explain the changes in prices of heating oil, or in prices of jet fuel, with the prices of with the changes of the prices in heating oil. That is not the case if we do a hedging of jet fuel with heating oil. Then we have still a risky portfolio because our coefficient is 0.89. Okay. Now we can improve this. How can we improve this? By using the co-integrated relationship. So the long run relationship, the long run equilibrium in between the levels, so the prices of jet fuel and heating oil price futures. And how do we do this, guys? How do we do this? What should we do right now? Nope. Okay. Let's not do it by the same way. So you guys know one other way to test this kind of things. I think it's Urca. Yeah, I have Urca. Okay. So imagine that, let's say, the jet fuel ADF test. So Urca has some really nice ways that we can modify our ADF test. Okay, this is hedge data, jet fuel. If we do summary here, ADF, ADF. What do we get? So first of all, the null hypothesis is still the same. We're just looking at more data from the test, right? The null hypothesis is that it contains a unit root. Now, what is our p-value? Our p-value is 0.024, which is smaller than 0.05, and thus we reject the null, and we say that the what? What do we say? So for 0.05, we can reject the null. Now the thing is that we have to be more exact than that usually. So for 0.01, we cannot reject the null. And thus we say that this guy has a unit root. We can do the same thing with heating oil. Heating oil, this one has a p-value that's higher. So this is more unit rooty than the other one. Okay. So let's now proceed to do the same usual model, that the same usual procedure that we were doing before. Okay. So first of all, we have to do the relationship to find the alpha and the beta, right? For our long run equilibrium. So let's say combination. It's LM of research data, jet fuel data. Now, this time, I'm only going to do it this way. Why? Because we cannot do jet fuel versus heating oil, because jet fuel cannot be traded in the OTC market. So even if the combination the other way around could be better, we cannot use it because it's not applicable. Okay, that's why I'm not doing combination 1 and combination 2 like we did with Canada and Australia. Okay, what was the first thing that we looked at it? Okay, 1-to-1. Let's just make this a summary. Combination is our alpha, is our beta. Okay, 3 stars, all nice and clear. So now we need to look at our residuals, error. So residual of combination. And what do we apply to our residuals? We apply the ADF test. Why do we apply our ADF test? Because we want to know if our residuals are stationary or not. So error ADF. So you guys know one more package. I'm gonna use again the URCA package for the ADF error. This time, because I know that my error won't have drift, I'm going to do type none. Value of the statistic is that, but that if I don't know the actual value, the actual critical values of the ADF, that doesn't tell me anything. Okay, so that's the summary. Error ADF, and look at this: augmented diffuser test, unit root, co-integration test. So what is my p-value? My p-value is really, really small. What does that mean? It means that our error are stationary, and thus we have an actual co-integrating relationship in between heating oil and jet fuel. Okay, so we reject the null hypothesis of non-stationarity. We have stationary residuals. Thus, we discovered two co-integrated variables that can be used in an error correction model, which is dynamic, and we can see how fast our prices move from the two different commodities. Okay, so for example, let's do my model, error correction model, okay, which will be a simple linear relationship in between the difference. Remember, now we can do the difference because we've corrected it by grabbing the residuals of our this is not a residuals, by grabbing the residuals of our long run relationship. We can correct our hedge ratio. Now remember, our hedge ratio before was 0.89. How do we know if we actually improved it? If it goes closer to 1, right? So the difference in the jet fuel prices alongside the difference of the heating oil prices, which it's heating oil. And what can we apply to better our estimation? We can apply the error, so the residuals of our long run relationship. However, we don't know the realized residuals. So in order to have a prediction of the future, we have to use what we know today, right? So we have to lag this 1p. That's one period. I think it's k. The one makes it forward, k minus 1 takes it back. Okay. I haven't. One. Oh. Try something out. Difference of jet fuel. Sometimes LM is a little bit picky on what actually decides to grab as variables. I'm going to replace the functions over here. Difference in heat oil. Difference in heat oil. And then this is our lagged error. Oh. This is one then. It's weird. It's 991. You have to remove the first value. There you go. So let's do tail and of this minus 1. There we go. Okay. And now the moment of truth. Have we actually improved the relationship that we could estimate with the heating oil prices towards getting nice hedging for the jet fuel? So again, let's go back to before. Before we had a hedge ratio on the differences of 0.89. Let's see what we get right now. In before it's lower, and we've done this for nothing, right? And it's higher. Oh, hold on. So we get no intercept. We get a hedge of 0.90, which means that we've improved the the visibility that we have on jet fuel by applying the errors that we have on our long run equilibrium for the jet fuel heating oil relationship. Questions, guys? So before we had where was it? Simple combination. Okay. Simple combination tells us by using the changes in prices in heating oil, how good can we track the changes in prices of jet fuel? If you can track it one-to-one, then heating oil is actually a perfect hedge for jet fuel, right? Because you as an airline operator you cannot straight out buy futures or forwards on jet fuel, then you have to get a proxy. In this case, we found that heating oil was a good proxy for it. But can we improve how good is this proxy? We can improve it by using cointegration. We found the long run relationship, the long run equilibrium of these two variables over here, and we use the residuals of that regression in order to apply it to the same equation that we had before. However, we are adding the errors of our long run relationship in order to improve the estimation. By doing this, we change it what was previously, for simple combination, we changed what was previously an visibility of 0.89 to a visibility of 0.90. Now, you can say, hey, 1 point doesn't really increase that much. But if you're talking about millions of dollars or maybe more, that you can reduce in costs such that you can track better your cost usage in fuel, then that 2 or 1 point in improvement means a lot. And I think also, so the coefficient doesn't mean anything if we don't look at the standard error, right? It's mod ECM. And just so we have a good idea, let's simple comp. So before we had a 0.89 with a standard error of 0.03. 0.39, so 0.04 basically. Now we have an estimate of 0.09, so it's better, and the standard error is lower, 0.032, which get us a much better visibility on jet fuel prices by using the changes in heating oil prices, which are listed in the OTC market, and we can use it to hedge against changes in jet fuel prices. And this is basically, guys, the error correction model that we were looking at before. So if we go, let's use this representation. Here it is. So what we modeled is actually the change in our prices. Okay. I don't know if anyone has any questions. This is actually very important, guys, because remember, you can use it to trade in the market. You can use it to lower your costs as a company just by finding what the long run relationship in between two variables is. Okay, but I guess there's no questions, so we'll end there. Something out of this will definitely come out to the test. So yeah, see you guys next week for the test. See ya. Have a good one. Best of luck.